What's up everyone? Welcome back to the Everything Startups channel. Today, I want to dive into a myth that needs to die once and for all. And that is that if your startup doesn't IPO, you have failed. That is complete BS. The reality is most successful founders never ring a bell on Wall Street and they're doing just fine. So today, we're going through 10 realistic ways founders actually cash out. And I'm going to break down each one in detail. The good, the bad, and the ugly. And by the way, I'm Evelina, founder of everythingstartups.com. So by the end of this video, you know exactly how each exit works, what kind of money we're talking about, and whether it makes sense for your situation. So let's dive in. Now, number one is strategic merger and acquisition, otherwise known as M&A. This is when a bigger company buys you out because you solve a problem they have or accelerate something they're trying to build. Here's how it works. Let's say you build an AI tool for customer service. Salesforce might buy you not because you're profitable, but because they can plug your tech into their platform and sell it to their millions of customers. That's strategic value for them right there. The money can be insane. We're talking about 5x, 10x, and even 20x revenue multiples if you're strategic enough. For example, Instagram sold to Facebook for $1 billion when they had like 13 employees and barely any revenue. And that's because Facebook knew Instagram was going to eat their lunch if they didn't act. The timeline for this is usually 3 to 6 months once talks get serious. And the process involves due diligence, cultural fit meetings, and a lot of lawyers. Now, the upside of this is that huge valuations and your product lives on in a bigger ecosystem. But of course, as with everything, there is also a downside, and that is that your vision might get diluted. Remember when Yahoo bought Tumblr for $1.1 billion? Yeah, that didn't go so well for Tumblr. So let's go to number 2, which is the financial M&A. Now, this is when someone buys you purely for the financial returns and not for strategic reasons. In this scenario, you can think how private equity firms or financial buyers tend to look at your EBITDA, your cash flows, and your growth trajectory. They want to see predictable, profitable businesses they can optimize and potentially flip in 3.5 to 5 years. Valuations are typically based on EBITDA multiples. So if you're doing 10 million in EBITDA, they might pay you 7 to 12x that. So 70 to $120 million. If you don't know what EBITDA is, we'll cover that in another video, so stay tuned. Now, the timeline is similar to strategic deals, but the due diligence is more financial focused. They're gonna dig deep into your unit economics, customer retention, and margin trends. So the pros of this are that you get liquidity, and if they're good operators, they might actually help you scale faster. And the cons are that they're gonna optimize for profitability, which might mean cutting teams or features you really care about. Here is the third one, the acqui-hire. And this one sounds brutal, but it's actually pretty common and not necessarily a bad thing. An acqui-hire is when a company buys you primarily for your team, and they might shut down your product entirely. Facebook was famous for this in the early 2010s. The math usually works out to about $1 to $3 million per engineer, depending on their skill level and how badly the acquirer wants them. So if you have a team of 10 engineers, you're looking at $10 to $30 million. The timeline is pretty fast, sometimes just 4 to 8 weeks, because they're not buying complex business assets. They're basically just buying the people in your company. Here's why it's not a failure, if you're thinking that it is. If your product isn't scaling, but you've built an incredible team, this can actually save everyone. Your engineers get great jobs at a top company, and you avoid a messy shutdown, and investors get some return instead of zero. And the downside is also obvious that your product unfortunately dies. But sometimes that is the reality, and an acqui-hire is the most honorable way to handle it. And at number 4, we have the good old IPO, which of course everyone knows what that is, and that's what everyone dreams of. So let me break down what actually really happens here. You hire investment banks who spend 6 to 12 months preparing you to go public. They audit everything. You do a roadshow pitching institutional investors, they price your shares, and boom, you're trading publicly. Okay, there is a lot of detail in there that we're not going to cover because it is quite complicated. However, the money can be huge, and you can raise millions and millions and millions, or even billions in primary capital. Plus, existing shareholders can sell some of their stock. But here's what they don't tell you about IPOs, is that they're really expensive and super risky. The banks can take about 7% of everything you raise, and they often underprice your stock, leaving money on the table. And then you're subject to quarterly earnings pressure forever. IPOs work great if you need significant capital to scale and you can handle being a public company, but it's certainly not for everyone, and it doesn't have to be your ultimate goal. Let's go to the 5th one, which is an SPAC merger. This one became huge during COVID, but has cooled off since. An SPAC is basically a shell company that's already public, and they merge with you to make your company public faster than a traditional IPO. So instead of 6 to 12 months, we're talking about 3 to 6 months. The valuation is negotiated privately with the SPAC sponsor, so there's less uncertainty than a traditional IPO. You often raise additional money through what's called a PIPE, private investment in public equity. SPACs, of course, also have some issues. The sponsor would typically get a whole 20% of the company in order to promote share. And PIPE investors often get better terms than existing shareholders. The key here is finding a sponsor who actually understands your business. Then at number 6, we have the PE buyout. And this is when a private equity firm buys a controlling stake in your company, but keeps it private. PE firms typically target profitable, growing companies doing at least $10 to $20 million in revenue. The process usually takes around 3 to 4 months, and it involves very intense financial due diligence. They want to make sure that they can see predictable cash flows and opportunities to optimize operations. They'll often bring in their own operational expertise, maybe replace some executives, and implement new processes. For founders, this can be a great deal, especially if you're tired of the fundraising grind, but still want to be involved operationally. You get significant liquidity upfront, plus upside if they successfully exit later. All right, let's go to the 7th option you have, which is the secondary sale. And this is my personal favorite because it is just so elegant. Instead of selling the whole company, founders and early investors sell some of their shares to new investors while the company stays private. You get liquidity without giving up control or going through a complex exit process. Now, some companies like SpaceX and Stripe have done this very well, and employees and early investors get to take some chips off the table, reducing personal risk while the company keeps building toward a bigger exit later. Process is usually much simpler than a full-on exit, and it takes around 2 to 3 months. The buyers are often late-stage VCs, family offices, or sovereign wealth funds looking for exposure to high-growth private companies. This works especially well if you're growing fast but not ready for a full exit, or if the public markets aren't receptive to your sector right now. Now, let's check out number 8, which is the ESOP liquidity. This stands for Employee Stock Ownership Plan, and it's all about getting liquidity for your team. The idea here is that employees get to sell some of their shares on secondary markets, even while the company stays private. This is huge for retention. People who've been grinding for years with paper wealth finally get some real money. The mechanics can vary quite a bit, but usually the company facilitates these sales during specific windows, maybe once or twice a year, and the buyers are similar to secondary sales, like investors looking for private market exposure. This isn't really an exit for the company, but it's a way to provide liquidity that keeps everyone motivated and reduces the pressure to exit before you're truly ready. Number 9 is the asset sale. This is when you sell specific parts of your business instead of the whole thing. Maybe your main product isn't working, but you've built some incredible IP, or you have an amazing customer database, or perhaps there's one specific feature that's pure gold. You can sell just those pieces. I've seen companies sell their customer lists for millions, and others sell their technology stack. And then there's others who sell specific product lines that don't fit their core strategy anymore. The timeline for this is usually pretty fast, around 1 to 3 months, depending on the complexity of the asset. The buyers could be competitors, adjacent companies, or even your customers who want to bring the capability in-house. This is especially useful if your main business is struggling, but you build super valuable components along the way. So instead of shutting down with nothing, you can extract value from the pieces that work. And number 10 is the soft landing shutdown. Now, the soft landing shutdown is the one no one wants to talk about, but it's sometimes the smartest move you can make. A soft landing isn't just giving up. It's strategically winding down while placing your valuable assets like your team, technology, customer relationships, and other things where they can thrive. Maybe you place your engineers, or maybe you open source your technology so the community benefits from all the hard work you've put in. Or maybe you transfer your customer relationships to a company that can serve them better. The key here is to do this with integrity and communication. Make sure to brief your investors early and help your employees find new roles. It's definitely not the situation you want to find yourself in, but it happens to the best founders. And many founders did do this, went on to raise money easily for their next ventures because people saw how well they handled adversity. All right, folks, so there you have it. 10 realistic ways to exit your startup. The key insight here is that there's no one-size-fits-all approach. The right exit truly depends on your business model, your growth, your market conditions, and honestly, what you want out of life. After all, the smartest founders don't just pick one path and hope for the best. They build and keep their cap table clean along the way, as well as their relationships with potential acquirers. After all, smart founders don't just pick one path and hope for the best. So, I'd love to know which of these resonates with your situation, and if you're building toward a specific type of exit or you're keeping your options open. Let me know in the comments below. And if this breakdown helped you think differently about startup exits, smash that like button and subscribe for more. I'll be back with the next one next week, so stay tuned.